You see, it's all a game of interest rates. And though I've never seen the Game of Thrones, I do know that winter is coming, literally and maybe figuratively. And the way we can avoid a figurative winter, when it comes to the economy at least, potentially, is if the Fed in the United States, Jerome Powell, and the Bank of Canada lower interest rates, general interest rates for the economy to spur some kind of economic activity, because right now it's looking pretty bleak. Unemployment is down, unemployment is way up. There's not as many people working. There's a lot of issues when it comes to productivity and GDP. There's a huge housing crisis. Affordability is at all-time low. So we have all these headwinds, and a big stick that the government has is leveraging the interest rates. So they have this lever they can pull anytime, and that will spur activity. But you have some challenges with that, right? You can't just lower interest rates and hope that everything kind of goes back to normal. There's this big thing called inflation. And with inflation, you don't want too much money coming back into the system, because when inflation is high, you have a stagnant economy. That's actually kind of directly related to the affordability crisis. Is your money's not worth as much as it used to because there's so much of it in the system. So we have to kind of curb spending. We curb spending by making money less sexy. So if we want to make money sexy again so we can spur activity, we got to be careful of how fast we lower it, because we don't want the same problem again. Unaffordability, high unemployment, right? Low GDP, low productivity. So what I think is going to happen is the Fed and the Bank of Canada is going to lower the rates, whether it's this week, the second week of September 2025, or later on, and hopefully that spurs some kind of activity in the market, because we need it big time. And when it comes to the housing sector, I'm specifically interested in this because obviously when you lower interest rates, mortgage rates tend to follow pretty closely behind that. And when the mortgage rates come down, obviously there's more activity. There's more people taking out mortgages because the monthly bill is lower, more towards your principal. It's pretty simple, right? And then when you have more mortgages, there's more demand in the housing market. Not that the houses are more affordable necessarily, but you know, the debt is more attractive for people who are entering for the first time as new homeowners, or people who are looking to sell, or it's just a much more attractive market for housing. And when you have this attractive market, you got to be careful, but you could definitely have some downstream effects when it comes to construction and appliances and infrastructure. So there's a lot of positive things that could happen when you lower interest rates, which tends to make mortgage rates come down. And when these mortgage rates come down, all of a sudden, you know, you have a spurred activity in the market. So there's a lot of excitement that could come from a rate drop. And really, it's just I think they're gonna do it, the Fed and the Bank of Canada, to really alleviate the unemployment, because there's a lot of downstream effects for lenders and businesses who are, you know, looking to make capex investments, or people looking to buy cars or buy homes. But the housing industry itself, like, it needs to be alleviated right now. We need some help on the finance side for people to actually enter the market, because right now with interest rates the way they are, between 4 and 5% in Canada and 6 and 7% in America, I could be a little bit off on those numbers, but we need some relief. And that will spur a lot of other sectors. But the trick here is you don't want to lower them too fast, because if you lower them too fast, all of a sudden there's demand. There's an influx of demand in the market. There's a lot of demand, and all of a sudden you have inflation again, right? And when you have inflation again, all of a sudden your money's not worth as much, and you could cause a speculative bubble or a crash in something like housing, right? Because there's too many people buying homes. All of a sudden, you know, the homes are more expensive and unaffordable again. So lower the rates too slow, which has been a criticism of Jerome Powell and the Fed, because they've been lowering it very slowly. If you lower them too slowly, you have the risk of a stagnant economy, which is what's happening right now. It's not a recession, but it is a recession right now. People in Canada, people in the United States are saying this is a recessionary environment. We have negative GDP, you know, 2 quarters in a row. We have very, very low, like I said, productivity, unemployment is up. So they need to lower the rates, but they don't want to lower it too fast, because you could spur another housing crisis or make inflation come back. So it is a game of interest, but hopefully winter isn't coming. Hopefully there's a light at the end of the horizon. Hopefully.